Hey, everybody, it's great to have you here. We are going to start pretty soon. I'm going to make sure that you can hear me and see my screen. So, Patty's my operations manager. She's on. She's actually out in Sacramento. I'm here in Silicon Valley. So, Patty, will you make sure that your computer, when you logged in, you can see my screen and hear me, and you can go ahead and just go to you can just text me, or you can just put in the little questions area that you can see and hear me. So we're going to start pretty soon, guys, maybe in about 30 seconds or less. I just want to wait to make sure that everyone can see and hear me. So I am not talking to myself for the next 45 to 60 minutes. In the meantime, I suggest you get a pen and paper. I was going to say pen or paper. Get a pen and paper or something to take notes with, because this will definitely be heavy in content, and you'll probably see and hear things in here that you possibly have never seen before, and certainly not positioned the way that I want to position it to you. So hold tight, and we're going to start in just a few seconds. Okay, I got the thanks, Patty. I got the text saying all is good, so we are ready to go. Thank you all for being here. The name of this training is the Diversification Myth. That's me over there with my arms crossed. It's so good to have you here, and I want to make this time of great value to you. I used to spend a lot of time on TV and going on to cable shows. This is me on Bloomberg. I liked going on Bloomberg simply because they have a great office right here in San Francisco, and it was good for me to get to, and they are a respected outlet. But I actually stopped. I stopped doing TV appearances because I kind of realized I became part of the problem. I had to come up with a soundbite. Everybody, by the way, has to come up with a soundbite when they're on. And TV, if you don't know it, is measured and managed into these 5-minute segments, and it's just very heavily managed. And so you basically can get a soundbite or two out, but I didn't really have the experience that I was actually helping people. It was good for my ego. It helped my business because people saw me on TV and I had that credibility. But ultimately, I did not have the experience that I was helping the people who did not connect with me or who did not become part of my world. And so I actually stopped doing it. But what I want to do is I want to show you what I did. I want to show you how I approached this whole investment thing, because I think you may, or parts of you may, see yourself in this. So let's do that. Let me show you what I did and how I did it. Now, before we start that, I do have to give a disclaimer. I am a certified financial planner. I am a registered investment advisor. And I have to let you know this: the Securities Exchange Commission and the Department of Business Oversight would be very happy that I let you know this information. So let me just quickly read this to you. The opinions expressed on this webinar are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about growing wealth. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Fearless Wealth LLC, that is the company that I started and founded in June of 1998. It is not a registered investment advisor. I am individually. The content of this webinar is solely for informational purposes and not a solicitation to invest. So thank you for letting me get that done. Now let's get into what I did. So when I started off in my 20s because I wanted to find out what really worked in investing. So I went to the big box advisors. I went to most of them, and I found that what they did for me really could not help me. So then what I did next was I went to the independent advisors, and I quickly learned that they had the exact same kind of conventional approach on investing. Their offices were slightly smaller and they were more boutique, but the results were the same. So then I kind of turned to the weekend workshops. I wanted to go to these weekend workshops. I did. I had time. I had lived in Asia for the early part of my 20s running a software company, so I was compensated well. I was fortunate. And so I was able to, when I came back to the States, take some time, and I went to many weekend workshops. And, they were awesome. I loved them. They were fun to be in them. But then what happened was I got hit with Monday, and I got hit with Monday again. And then I got hit with Monday again. And, it only needed 4 or 5 Mondays in a row before I really wasn't implementing anything. So the workshops didn't really help me. And then one of the last things I did was what I call the pick of the week newsletters. Maybe this is the pick of the month newsletters. But I figured, well, all I need to do is figure out what symbols to buy, and then that's good. Well, I was getting inundated with tens of symbols a month and which ones to buy, and they all sounded great, and they all wrapped up into great stories and reasons why and how they were going to change the world. And I was just left with not doing anything because there were just too many to choose from, and I wasn't doing anything. And so I went through this, and yet I was really no closer to finding out what really works. I actually felt like an outlier. Like I was outside of the big box advisors and the independent advisors and the weekend workshops and the pick of the week newsletters, right? So half of those things above are people do it for you, and the other half is kind of you do it yourself. But I felt like I was this outlier investor. I was outside of that because the do-it-yourself stuff wasn't working, and I know those conventional advisors, they weren't able to really help me. So I got to work, and I wanted to find out what was the thing that mattered most. And so I tested everything I could test. I tested fundamental investing and value investing and deep value investing and diversification investing. I know that's really not a term, but it is what people really do. I checked out buy and hold investing, and I trust my broker, which I trust my broker investing is really, here's my money. Please, please, please. At least it won't be my fault, even though I can never outsource my responsibility. I trust you. Please go do it for me. I looked at sentiment. How does sentiment impress upon investing? So I kind of looked at what I call sentiment investing. I looked at option trading. I looked at Forex trading. I looked at technical analyzing stocks and information. I looked at everything. And I just want to know what worked. Did diversification matter? Did I need to be diversified? Yes or no? And maybe I just didn't find the right advisor, whether it was a big box advisor or a conventional advisor. Like, I put all advisors kind of under Wall Street. Like, could they help me? Did they have something? And I was open. If they did, great. Let me just find out where they are. And I had other questions. I just want to know if active investing or passive investing, like which worked better for whose personality and what type. And should I study companies and their quarterly reports and all their numbers? Like what mattered? And what mattered? Now, the title of this training is The Diversification Myth. So yes, you are clear that diversification, I'm going to talk about that and time again. That's going to be one of the main themes that threads throughout this training. But what I found that worked the most, that if there were 10 steps to get you to have a great, safely accelerating portfolio, if there are 10 steps, of the 10, there was one that represented about 80 to 90% of all the success or lack of it. The other 9, each one of those other 9 steps maybe represented 1% of the success. And that one step, the one I wanted to focus on, represented 90%, 91%, 89%. It kept coming back to this one thing. And so the answer I got was study price. Everything you need to know about what is going on, as much as you can know what is going on, is in price charts. Study price. Because if you study price, there's a couple other things I'm going to show you them. Then you have the information you need. I mean, you can find a quote-unquote great company. Some believe Walmart's a great company. And I'm not saying whether it is or isn't, but if you went with this is a great company, well, Walmart went sideways for over a decade while the stock market went higher. So it's not about great companies. It's about following price. And so I just want to show you my results. Now, I'm not saying you will get these results. I'm not saying you should believe these results. I'm simply telling you what has happened up to this point. So just comparing it against the S&P, from 2000 to the end of 2006, that's 7 years, the S&P went up 8%. Yeah, and then from the beginning of 2007 to the end of 2014, it went up to a total of 78% for a total combined growth of 86%. That means from January 1st, 2000 to December 31st, 2014, S&P went up 86% over that time period. Now that includes dividends. That's 14 years. That's a long time. Now, my approach that I designed and created, I called it market probability, or MP1X and MP2X. So you can actually do anything between 1X and 2X, but I'm just going to show you what MP1X did. And I'm also going to show you how it's kind of how straightforward it can be. And I'm going to talk about how, man, humans, they want to confuse and complicate and make things very, very intricate. But I steered away from that because I just followed the results. So in those first 7 years, from 2000 to the end of 2006, MP1X went up 56%. And that second block of 7 years, from the beginning of January 2007 to the end of 2014, it went up another 175%. This is not day trading. This is not options or Forex or currencies or commodities. So nothing's wrong with any of that. I just learned you didn't have to do that. So those combined numbers together for, again, MP1X is 231%. Now, again, I'm not asking you to believe that that happened. It did. I'm not asking you to say that it's going to happen again. It is continuing to work, and I'm going to show you why. I'm simply pointing out to you, these were my results. This is what actually happened. So what I want to do is just explain to you what happened. Now, when I went looking, and I was unbiased, I just wanted to find out what worked. I was told by advisors, big box advisors, small box advisors, conventional advisors, that this is how the stock market is. Just stay on your bike, just slow and steady wins the race, and eventually you get there. Okay. And I was also told that, man, the investment world is so random. So many things are random that don't even try to make sense of it all because it's just way too complicated. And you know how complicated it is? It is so complicated that you first have to read the quarterly reports and figure out which are the deep value companies or the great companies and figure out the ones that you understand and you can relate to. And then you have to buy a portion of that. And how much should you buy? There's a very intricate thing to do. And then, well, don't buy too much, because if you buy too much, then it's not good. So you're going to want to diversify and diversify well, and maybe have 50 to 100 positions and buy, maybe it's mutual funds. And it's not just that. Then you got to get into some bonds, because since you're never actually going to sell anything, you're going to have things that go up when everything crashes. So that's why people diversify, because Wall Street, one of their biggest fails ever, and they have many fails, is, I guess, just not being honest. The reason they want people in stocks and bonds is because they're never going to get you out of stocks. So you have to be in bonds, because bonds will go up, generally speaking, when stocks go down. And that's why they have you diversified. Well, wait a second. Why don't I just get out of stocks when they start falling? Oh, that's too complicated. You're predicting your timing. And so they create this really complicated situation. They inculcate us to believe that things are complicated and confusing and so much random, and they're creating the confusion. So this was my takeaway. And I was fortunate that I was in my 20s, that I had time to step aside. I was able to literally step aside and not worry about income. I stopped working for a few years. Well, I really was working, but not in the conventional sense. I wanted to find out what worked. And so what I found out was conventional investing was designed to return all of the upside of the market you'd get, minus commissions and fees. And you'd get all of the downside, minus commissions and fees. Okay. And look, there's really nothing you can do about it. So just, now I'm saying this, I figured out, well, just buy the index. But that's not what they would say. And there have been indexes around for quite some time. But what they said was, we're going to have to, diversify. Well, what they ended up doing was they diversified you into the market. Well, if you own 25 mutual funds or 15 mutual funds or 60 ticker symbols, you own the market. Well, if you own the market, you're going to get the results from the market. So you don't need to diversify. You can just buy a ticker symbol SPY, and you can get rid of the commissions and the fees. So this was my first huge breakthrough. Like, oh my gosh, we don't need them. Nobody needs them. Maybe if you need some help with getting organized, financial advising, totally fine. Get a financial advisor, but just buy SPY. And that's what I started with. I just bought the ticker symbol SPY. Very simple, very straightforward. Got rid of all the commissions, got rid of all the fees. So my first huge takeaway, and for what I call outlier investors, people who went to the big box advisors and the independent advisors and did the weekend workshops and bought the pick of the week or pick of the month newsletters, I call them outlier investors because they're an outlier. They want to find out what really works. So the first thing I found was really those people can't help. They can't help me. So that was kind of good and kind of confusing and weird. Like, well, if they can't help me, how come they all have like the biggest buildings in every town on the planet? Like, what's going on there? So I wasn't satisfied. I wanted to keep digging, and so I wanted to see like, well, there's got to be more. There's got to be more. And this is probably me wanting to complicate things. Like, is there more? But I was on the right path. So I learned that the stock market wasn't this. It was more like this. It was ups and downs and ups and downs and ups and downs and ups and downs. And anyone who's ever studied the stock market, they know this. They can look at price charts. There's those things again, price charts. Now, one of the interesting things about looking at price charts for a human is we have something called a visual cortex. And our visual cortex is powerful. We can find patterns. We can see the bear hiding in the woods so we know when to run or not go into the woods. Like, human pattern recognition is amazing. One of the best on the planet. Well, that's what's great about price charts and looking and studying price. You can see the patterns. But what I realized was investing really wasn't this way. You didn't have to do this to brush your teeth or to invest. It could just be really simple. And I learned that, you know what? Things aren't actually random. There's cycles and patterns. This chart you're looking at right here, this price chart, is a measurement of Earth's temperature changing over the last 450,000 years. Now, I'm not showing this to you to get into debate whether climate change is real, is not real, what part of it is real. I'm simply pointing out to you, this is actual evidence, real evidence that shows the temperature of the Earth changing over time. It gets hotter, it gets cooler, it gets hotter, it gets cooler, and so on. There's cycles. Well, if there's cycles to the temperature changing on the planet, are there other cycles? Here's another pattern cycle chart I saw. Again, it's a price chart, but this is of sunspots. Literally sunspots. How many sunspots there are? Do you notice a pattern? These are sunspots. This price chart's about 90 years old. And of course, we all know about cycles in nature and in seasons. Spring goes to summer, to fall, to winter. It repeats. There are cycles all over the place. Of course, there's cycles and patterns. Of course, there's cycles and patterns in the world of investing. So the second big thing I got was, wait a second. If there's cycles and patterns, like how can you use these cycles and patterns? And how do these cycles affect people's money? Right? Because if I just do the buy and hold SPY, I get rid of the commissions and the fees and all that overhead. And that's absolutely going to help me be in the top 5% of all people's returns over any 5 to 10 year period for the rest of my life. So that's going to help me. But wait a second, if there's cycles and I'm seeing that there's periods of time you shouldn't be in, how does that affect people's money? Well, what I was taught was, no, just diversify. Just buy some large cap stocks and some small cap stocks and some growth stocks and some international stocks and some mid cap stocks and, throw some value stocks in there. And then they say, well, and throw some bonds in if you're at a certain age. Well, the reason they tell you to buy bonds is because they're never going to have you get out of stocks. So something has to go up when everything falls. So what if this is your portfolio with your diversified positions? Well, what happens if things in the market get really bad? What if the stock market falls 49% like it did beginning in 2000? Or what if the stock market falls 58%? Actually, it started falling at the end of 2008, but most people think of it as it started falling at the end of 2007, but most people think of it as the 2008, 2009 stock market fall. It fell 58%. Really? I should keep everything in? And the stock market fell 23% in 2011. Now, I'm not saying there's going to be a huge fall in 2015. Maybe it'll be in 2016. Maybe it'll be in 2017. Most well-respected, very well-respected money managers who themselves are billionaires and or they manage tens or hundreds of billions of dollars, they all say, yeah, there's probably a 30 to 50% correction still to come until we get out of this cycle. So conventional advisors say, oh, just keep it all in. This is insane. And the reason it's insane is because when the market falls, the orange line on the screen is the S&P 500 falling. And it's falling from 2007 all through 2008. The blue line is correlation of all those S&P 500 stocks. Well, guess what happens when the market starts to really accelerate its fall? Everything falls. Diversification doesn't help. And in fact, diversification was designed, one of the reasons diversification was designed is so conventional advisors could be like, hey, look, you own 100 stocks or 25 mutual funds or 15 mutual funds. Look at how complicated that is. But all they're doing is creating just the market for you. They're just making it complicated so they can justify their fees. Well, again, if your total portfolio is the market, you don't need to have anything other than just one ticker symbol. And that helps you, except when everything falls. And what you're seeing here is literally 6 exchange-traded funds that represent thousands of shares. You have domestic stocks in the U.S., you have international stocks, you have dividend-producing stocks, small-cap stocks, mid-cap stocks, deep value stocks. They all fell. Do you think diversification helped? No, didn't help you. Didn't help those outlier investors who are noticing, who have noticed, everything they've tried doesn't work, and they still want to know what really works. So it's like, okay, well, there's probably then at some point I should not be in the market, right? So at some point I need to figure out how to not be in the market because there's these periods of time where you don't want to be in the market. So the question was, did everybody get hurt? Like, did everybody get hurt in 2000, in 2008, or in 1987, or in 1974 to 1975? Like, did everybody get hurt? And what I learned, and I'll show you, is some people had their money out of the market, just had it in cash. They saw what was happening. They saw the 100-foot waves on the ocean in the market, and they said, "Oh, there's no reason to deal with that. I'm just going to go back to safe harbor." And safe harbor through the history of investing has been your local currency. In this case, being in the U.S., it's the U.S. dollar. So I found there were people that, sometimes you don't need to always be out on the ocean, but be out on the ocean when it's calm and things are good. And so the next biggest thing I learned was this whole myth of diversification. The best investors, they were not diversified. They did not stay in the market all the time. They cut their losses. They automated their process. But the biggest thing was there was no diversification. This was a big insight. And I thought, well, this can't be right because how come I haven't heard about this before? Certainly, this should be wrong. This has to be wrong because look at all the trillions of dollars that the big box advisors in very complicated approaches with management fees, and this can't be right. But what I found was this county. I mean, what if everyone who grew their money exceptionally well was from the same county in the same state? Like, what if they went all to the same junior college? That would be interesting. I would then want to be like, well, what's the junior college in that county, in that state? Who are those people? What are they doing? Oh, none of them are diversified. Really? So look at this. There's a guy named David Einhorn. All right, some of you may know him, some of you may not. Younger guy, right, below 50, under 50. He himself is a billionaire. He himself manages billions of dollars of other people's money. Well, his top 5 positions represent almost 44% of his portfolio. 5 individual stocks. 5 individual stocks. That represents 44% of his total portfolio. That's not diversification. That's concentrated. Okay, well, are there other people like David Einhorn? Warren Buffett. Most people have heard of that guy. His top 5 positions represent almost 67, 2/3 of his total portfolio. We're talking about a portfolio that is hundreds of billions of dollars. He himself fluctuates between the second most richest person or the third most richest person on the planet. He's not diversified. He's got 2/3 of his money in 5 stocks, not 5 sectors, not 5 country indices, but 5 stocks. Are there others? Bill Ackman. His top 5 positions are in almost I'll round down, 86% of your money. You may not know Bill. He's not as publicized as other billionaire investors, but he himself is a billionaire. He manages $15 billion of other people's money. His top 5 positions, 86% of his portfolio. That's not diversified. Bruce Berkowitz, where you may or may not know him, his top 5 positions, 88% of his positions are in 5 stocks. 5. That's not diversified. The best investors on the planet don't diversify. They don't. Including perhaps, and most people don't know this name, the best hedge fund manager ever on this planet. His top 3, listen to this, I want you to get this. His top 3 positions are in ETFs. Forget individual stocks, because you may be thinking, RC, that's great. These guys are smart. Like, they are really smart. They've got like 1,000 people working for them. They can find the stocks and do that. Here's this guy, Ray Dalio, who's worth himself more than those other guys were managing. He himself's worth about $15 billion. He manages about $165 billion. In one of his major portfolios, he's got his top three positions in almost 87% of his money in that, in this one portfolio I'm talking about, which has about $14 billion, is in 3 positions. Now look at this. It's in off-the-shelf positions. He's not diversified. The other 4 were not diversified. I'm not going to go through and show you everyone, but here's just a quick list of a lot of these people. Some of them you may have heard of, some of them you may not. How many years they've beat, if you look at the bottom row, how many years they've beat the S&P 500, 10 years, 15 years, 20 years, all the way out to about 55 years, and by how much per year they beat them by. It's just not 2 people. There's many people. What are they doing? They're all coming from the same junior college in the same county in the same state. What are they doing? Well, they're not diversifying. They're managing their losses, so they're not always in. Now, this was huge to me. Again, I'm in my 20s, so I have no bias. I'm searching for myself. I'm looking for the evidence. I'm following the evidence. I actually don't care what the evidence is. And so I just, was that it? Not that there needs to be more, but was that it? And I found truly the biggest secret of all. And I'm leaving this to last because I think people get to this point this is like the final place they get. And I'm an outlier investor. And I think when others kind of be like, you know what, I think I might be an outlier investor too. I know the big box advisors can't help me, or those independent advisors can't help me. Like, I get that, doing it myself can work. But the weekend workshops and the pick of the week or the pick of the month newsletters, that's not going to help me. But I am that outlier investor. So what's the biggest secret of all? And the answer is this. Look at this. The last 5 years, there's a lot on this chart, but just go with the red squares. For the last 5 years, individual investors have underperformed the S&P 500 by 2.73%. Individual investors doing their own thing have underperformed an unmanaged index that you could just buy. Over 10 years, a little bit better, they only underperformed the S&P 500 by 1.52%. But it gets worse now. The longer we go, now 20 years, people underperform. This is an unmanaged index. Unmanaged index. They underperform by 4.2% over 30 years, which for most people is the life of their investing. They underperform by 7.42% over the life. Not growing your money by 7.5% every year for 30 years is catastrophic. And the reason is this. Our brains were not designed to grow money. We have our prefrontal lobes, which are the newest part of our brain. Second was the cerebrum. Yeah. The third is our paleo-mammalian brain. Now, I know there's parts to it, but this is how our brain came to be. And the oldest part of our brain is what's called the R complex. This literally sits on top of the brainstem. Now here's the thing. We think we can outthink everything, that we have this amazing brain, and we do have this amazing brain. But here's the thing. This is what happens. We think we're this guy up here. We think we're the logical person, but we're not. We're out of control when we put our money in the market. We are out of control, right? It doesn't matter what other parts of the brain we have. This is what's going on in our brain. As soon as money goes into the market, we become this crazy guy, this crazy out of control guy. And we go to weekend workshops and we read stories about stocks from Pick of the Week newsletters or Pick of the Month newsletters. And we're like, oh, that's so logical. I can do this. This is so easy. And we think we're Spock. But we're not. We're out of control. I don't know you individually. I've been studying people and their money my entire adult life. And I can tell you when money goes into the market, especially when someone does it themselves, they act crazy. So the fourth and last thing I learned is we are just very bad at growing money. Humans are bad money growers. Like really bad. But I want to grow money. And I know diversification doesn't work. I now know my brain is against me. I know I have to manage losses somehow. I know there's patterns out there. I know that it can be really straightforward, like with a couple ticker symbols like the S&P 500. So how do I figure this out? And I got back to those cycles. I got back to those price cycles and those patterns. And so I started building. And the place I started building with, and this may sound really weird to you, is I looked to literally the casinos. Because human nature is on trial every day in the casinos. And I wanted to understand the probability of whether I could win or lose. Because there is a probability. And blackjack, there's a probability of winning, 49.5% if you follow all the rules properly. But it turns out you can actually increase your probability if you know how to count the deck and know how many face cards have been played by the dealer. And when you know the count, and if the count is high, then you have a high probable chance of winning your hand. So you want to bet more. And if there's a low count on the deck, you just do the table minimum bet. And so you're using probability. You're not timing your cards. You're not predicting. You're simply forecasting. Now, here's the thing. A forecast is not a prediction. A forecast is a probable statement about the future. So you're literally saying, well, if there's this probability of having an 80% chance of winning my hand, okay, I'll probably place more down on this hand. And what I noticed, and I think what other people notice, is probability changes. And, sometimes that's the baton that's getting handed between runners in a relay race, right? And so sometimes you want to be in the market. There's a high probability of making money in the market. And sometimes you want to be out of the market. This is straightforward. This is not complicated. This is looking at the history and studying price and following the evidence. If the evidence would have shown that I should be a fundamental investor, then I would have done that. I had no bias. I just wanted to know what worked. And so what I did was I started with the S&P 500. And I said, all right, well, this is the most followed index on the planet. It represents 25% of all the publicly traded companies by market cap on the planet. So I'm going to start with this. I started with the S&P. And I wanted to know whether we were in high probability or low probability, or, who's running with the baton around the track. I wanted to know. So I literally put a 10-month moving average on the S&P. And I said, okay, when the price is above the 10-month moving average, I buy, and when it's below, I sell. And there are a lot of false signals and get out, whip out, getting whipped in and out. So I was like, okay, one moving average is not enough. So I put 2 moving averages on. And I said, oh, this is better. A fast moving average and a slow moving average. Now, if you don't know what a moving average is, what it does is it takes the closing price of the last X amount of periods and averages it into one price. So if you are looking at a 10-day moving average, it takes the closing price of the last 10 days and plots a point. And then you have a line that is a 10-day moving average. So I put 2 moving averages on. And I looked at different time frequencies. Should I look at a daily chart, a weekly chart, a monthly chart, a yearly chart? What moving averages should I test? And I literally tested tens of thousands of combinations on daily and weekly and hourly and half-day charts and monthly charts. And, is it the 10-day and the 20-day moving average? Is it the 50 and the 100? Is it the 66 and the 99 moving average? I looked at all those, and what I came up with was this. Now, this is a price chart of the S&P 500. And you see 3 reddish columns. Well, those red columns, those turned out to be low probability sections of the market where you did not want to be in the stock market. Being in the stock market would have hurt you. Not about diversification. It's about knowing the probability, right? People often think that if they're just diversified, they'll be safe. But actually, that really hurts you. And if you just know when to be in and out of the market, then you can secure your portfolio and you can secure your finances and you can have more choices and freedom with your life. And so I want to show you these I want to show you what happened with real money, not just mine, with members and people's money I advised and managed. And so I'm zoomed in now. You have these 3 sections, section 1, section 2, section 3. I just want to show you what happened when probability changes. So for the sake of time, and there's no reason why we can't, but just for the sake of time, let's just look at number 2. Number 1 did very well. I just want to look at number 2 because not mostly, it was the most painful stock market correction of anyone alive below the age of 80. And so how did this do? How did market probability 1x or MP1x, how did it do? How did it protect and grow people's money? So this is what we got here. Now, the top chart is market probability, MP1x, and the bottom chart is the S&P 500. At the beginning of 2008, there was a signal. Now, one of the amazing things about market probability, not just how straightforward it is, but one of the things it does is it eliminates 90+% of the noise. So you can just get the signal. And so the signal happened. And let's say you had an account that was worth $100,000 when that signal got signaled. You went to cash this whole time period, and you did not lose money, and you're not exposed to that volatility. And at the end of that time period, you still had your $100,000 when the signal changed to get back into the market, when the probability of being able to safely accelerate your money was alerted and you got the signal. So here you are with your 100,000 while the rest of the market, generally speaking, is down to 73,000. They lost, much more, but then some of it came back, but now they're 100,000 down to 73,000 and they're 18 months older. They're a year and a half older. So that's not bad. A lot of people would like to not lose $27,000 or 27% of their money over an 18-month period, let alone that's if you stuck with it. I have met a lot of people who couldn't handle the pain anymore and they got out, and some still have not gotten back in. So not losing is pretty good. So the money grows. in both accounts. It's market probability 1x, just in, a ticker symbol. It could be the S&P 500. It could not be. I tell my clients and my members what to invest in and how to invest in and how to keep it straightforward. But here we are into 2011. And market probability 1x, or MP1x, is at 122,000. And the S&P is at 89,000. Or if people just did the buy and hold, they're at 89,000. Now, if you're with a big box advisor, it'd actually be below this number because they're charging management fees and other fees that you can't see. And really the biggest fee you're ever going to be charged by a conventional advisor is underperformance. But because you never actually see it, you don't realize that's the biggest fee you'll ever pay. And so MPX signaled the probability of making money in the stock market changed. And we got out. Now, the 122 stayed at 122 when we got back in right here. But during this time period, the market went up 6%. So there's a lot of opportunity loss there. But staying into the end of March of 2015, the money starting, remember, at the beginning of 2008 at 100,000 is basically doubled to 200,000. Where if you just would have stuck with the buy and hold, buy and pray, with no fees, no commissions, and there are, you'd be at 154,000. Now, I'm not saying you started with 100,000. Maybe you started with 10,000. But all things being equal, I'd rather have $200,000 than 150,000. And if you started with $1 million, then the difference is even more. But even if you started with 10,000, I'd rather have 20,000 than 15,000. So what market probability 1x, and you can do 1.25x, 1.5x, 2x, you could have $400,000 at the end of the first quarter of 2015. I'm just showing you market probability 1x because to a lot of people, just even these types of experiences are hard to understand and even believe. And I'm not saying you should or shouldn't believe them. I'm simply saying what has happened and what is happening for other kind of outlier investors. And so as I showed this before, I found the answers. I found the answers that, you know what? This whole diversification thing, total fail of advisors. Total myth. There are periods of time where you want to be out, right? And if you just follow it, you're going to get what the stock market does. If you do it yourself and just do the S&P, but putting together market probability, it becomes a very different experience for people. And it's based on probability. It's based on how we actually operate and work. And that's one of the differences that makes a difference for my clients and my members, is that they don't have to suffer through the last 58% fall or the one in 2000, which was 49%. And as I said before, most well-regarded billionaire money managers say, yeah, we probably got one more 30, 35 to 50% correction in front of us. Jeremy Grantham is one who I think he manages $115 billion. And he has said very clearly, yeah, we have one more of those in front of us before we kind of clean things out. So the question is, could this work for you? Like, hey, RC, that's great that it's worked for you. I don't know you. Yeah, you live in Silicon Valley and, maybe it's worked for you. But the question is, well, can it work for me? Really, that's really what the question should say. Not can it work for you? Can it work for me, RC? So, here's a couple examples. Jules Bennett tried it. Jules is a single 7th grade school teacher in his 20s, lives over in Oakland. He uses this in his Schwab brokerage account and his 403b retirement account because he works for a school. He has a 403b retirement account. And it worked and is working for him. It works in brokerage accounts. It works in 401ks, 403bs, IRAs, 529s. It works in all of those heavily confined vehicles. Or Paul Brannon. Paul Brannon, he's married. He's a VP at one of the largest investment brokerage houses on the planet. If I mention the name, you would absolutely know it. This works in his 401k. It's worked there and it's continuing to work for him. Paul's much older than Jules. It worked for Richard Green. He's married, has a family, lives in Silicon Valley, very, very accomplished serial entrepreneur. He uses his daughter's 529, his 401k, his wife's brokerage account. It has worked for him and is working for him. Or Mary Jo and Lee. Been married 40 plus, maybe it's even 50 plus years, retired. They have it in their IRAs. It's worked for them in their IRAs, and it is working for them. This works because of how straightforward it is, and because it's based on literally following the evidence. It works for small amounts of money, $50,000, and large amounts of money, $500,000, $5 million. Like I said before, it works in IRAs, traditional IRAs, SEPs, simples, variable universal lives, annuities. Yep, even those ones. Inherited IRAs, 529s, superannuation funds if you live in Australia. It works for retired people, active earners, long-time earners, young earners. This is an approach that works, and one of the reasons why members love it is because it's so straightforward and because you can simply just already use the vehicles you have and just layer this in, just plug in this approach, this straightforward approach that I call market probability. So, how can you accelerate your life? How can you do this? And, the thing is, quite honestly, I used to only share this with my clients who had $1 million or more in the stock market. And over time, they'd say, hey, can you talk to my brother? Or can you talk to my sister? Or can you talk to my friend? They don't, have 7 figures in the market. Could you just talk to them for an hour? And so I built this in a way, I built the strategies and the tools and kind of the structure around it. So, you could get access to these through the training videos and through connection with me. And so that's what I did. I built I call it a membership. I built a membership so people could have access to it. So I could show them how you could defer all your gains, literally all your gains, even if it's a brokerage account. I would show them these nuanced ways that, used to only be accessible to people who are worth millions or tens of millions or hundreds of millions. But because I'm always searching for the best way, or kind of like for these life hacks or these investment hacks, like how can you get a better return with less effort? So I showed them, and I will show you. And I show them, and I can show you exactly how this strategy, market probability, works. So you understand, so you get that you can do this and that it is straightforward. And I want to send you a weekly status update, just let you know where it is. Because take 30 seconds a week and go, yep, we're still in green light mode, still in high probability mode. Okay, market's been really sideways, and the news and all that noise out there has said things are gone crazy, but no, still in green light mode, we're good. And I'll make sure I send you all those interim signal alerts. So when there is a signal that eliminates all the noise, you will know. But I want to be clear about something. This is not more content that you need to or have to digest and feel bad about not digesting and reading. Everything's free today. Like literally almost everything is free today because of the internet. Obviously not everything is. Houses cost money. Health is not free. You have to do things. But, content is pretty much free today. So this is not just about more content. This is not just more pick of the week ticker symbols that you don't know what to do with. That's fine if you read those newsletters. They're great. The people who write those are great storytellers. I have them. I love reading them. They kind of make me feel smart when I talk to my friends at the gym. I'm like, hey, did you hear about this? And I can describe this ticker symbol or this company story. And it makes me it elevates my status with them and makes me look smart. It's not actually helping me grow my money, but it makes me look smart. I don't need to do that for you. And this is not just another guru expert hiding behind emails that you can't connect with. I want to connect with you. And that's why this is very different. That's why outlier investors, people who have kind of tried the do-it-yourself and tried the big box advisor and the conventional advisor approach, they're kind of what I kind of call outlier investors. Now, what's the value of the strategy? Look, if I could show you how to defer all your capital gains until when you need them, even past the age of 70 and a half, which is when the IRS demands that you start taking distributions from your IRAs and your 401ks, I'd simply show you how you can defer all capital gains for your entire life to your next generation. I'm going to give you the trainings. I'm going to give you those weekly status updates. Not complicated, not 20 or 30 minutes of reading, but just, hey guys, we're good. This is what's going on. I'll make sure you have the interim alerts. That's the value of the strategy. Now, the value of the strategy is more than that. To avoid 50% losses and to shorten the amount of time that you can acquire the point to stop working, certainly the value is more than that. But that's what it is. I want to show you exactly how it works and why it works. I will show you how to invest it. I'll show you what to invest in. I'll give you those choices. Not too many, just a couple. So if you like to be more, if you can handle more price movement, that's fine. I'll show you. But one thing I also want to do, and this truly is free. Now I'm saying juicy bonus today, but it really is kind of a key, and it's a key to my library. I've been building tools and doing research for my entire adult life. And you don't ever need to use another strategy, ever. You could just use market probability, MP1X, and you would be in the top 1% of all investors over any 5-year period forever. That's not me being hypey or hyperbole. That's actually what has happened and is continuing to happen. But I have another amazing strategy called the LTEC strategy, long-term economic cycles, that told my clients to get into gold, and they took the full ride of gold from 2000 to 2012. I'll show you that strategy because I know if you're like me, you love learning. I'll show you these other strategies. I'll show you my obvious trend index. This is a strategy. This is an index. And look, yes, I say to you, only use market probability ones, but I know if you're like me, you like looking at individual stocks and it's fun and maybe it's a bit of a hobby. Obvious trend index, which underneath the obvious trend index is the obvious trend strategy. I show you how to literally buy the world best companies. These are the companies that are the best in the world at what they do. They dominate their sector. They dominate their industry. And you literally buy them for 20 to 50% off. Companies you've heard of, Apple, purchased 40% off. Microsoft, purchased 35% off. Intel, purchased 35% off. Berkshire Hathaway, purchased 25% off. Disney, purchased. Nike, purchased. Like, if you want to know the safest and most effective way of buying companies, buy companies that have already won. Nike's not going anywhere. Disney's not going anywhere. Wells Fargo's not going anywhere. Philip Morris is not going anywhere. Altria Group is not going anywhere. B of A is not going anywhere. Some people thought at some point B of A was going somewhere, but it's not. We now know. Schwab is not going anywhere. Every major company on this planet has gone through a period where they've tripped up, they've skinned their knees, they are hated by the market, but they're not going anywhere. That's the magic. That's obvious trend. And I have an index that I have for you, and I show you how it works. So I get if you want to do that, but I'm giving it to you for free. This is not a bonus. This is literally free. Hey, it's there if you want to do it. I give you my 30-day market forecast. It's a forecast. It's a probable statement about the future. I look at the price charts, and I tell you what's going on. I give you all my investment tools that I personally use for my money management clients. I give it to you. I built a real estate course in early 2000. I stopped delivering it in 2006 when this course, I built a tool called the House Dashboard that literally tells you whether you should or should not buy any individual investment property. You can have it. Maybe you never read it, that's fine. Maybe you just get the tool out and use it when you go buy individual investment properties. It's yours to use. You can have access to my cash flow engine course. This was a course I ran in 2009 and 2010 that a lot of my clients wanted to know, hey, RC, I see that you have income coming in from more than just one business. How do you run those other businesses more passively? How do you do that? And so I showed them. Now, when people bought that course, the cash flow course, it was $12,000. I'm just writing down 5,000 because then the number gets so ridiculous, no one believes it anyway. But you get free access to my library, and that has a value of at least $16,000. But here's the thing, probably the single best thing I can do to help you I know I don't know you, but to help you safely accelerate your portfolio in your life is to make sure you connect with me personally each month. And each month what I do is I get on the phone or get on a web share, screen share. You can ask me anything. You can personally ask me questions. I call something called speed investing, where you give me a ticker symbol and I deconstruct it and tell you what I see from a price chart point of view. People are missing the connection in life. It's not enough to just have a newsletter or a weekend workshop. It's about building a connection with someone that you can ask, someone who's a little farther down the path than you. And that is why why clients and why members say, I've been looking for that connection. And that connection alone is one of the key reasons why members are able to do what they know they should do, because they're able to connect and ask the questions that matter most. You get that MP strategy. You get the keys to my library. You get to connect with me and ask questions. Yeah? You get those things. Now, I get that you probably don't have $22,000, and I get that that's a value. And, what is it more than that? Is it slightly less? But my offer to you is for a little over $2,000. You know diversification is now a myth. You know that's one of the Wall Street's biggest fails. And so I give you access to everything. You get access to everything. You get to ask questions. You get to see how the strategies work, all of them. If you want, you don't have to use all of them, but you get to see all of them. And if you sign up for an annual renewal, I will make the price much smaller. I'll make the price $9.95 a year, and I'll make sure you know when to be out of the market, when to be in the market. I will give you access to the other strategies. I will invite you to connect with me. It's that connection that's the difference. And I know you've all heard this statement somewhere in your life, but insanity is doing the same thing over and over again, and it's expecting different results. Now, I think Albert Einstein, who knows if he was the first one to ever say that, but one of the interesting things about Albert Einstein is he spent most of his time looking at the problem. So if he was given an hour to look at a problem, he would spend 55 minutes on the problem and only 5 minutes on the solution. I was able to do that in my 20s. People in their 30s and their 40s and their 50s and the 60s, they don't have that ability to go back 1 to 4 decades and do that. I was able to spend the time. What is the real problem? Oh, people don't know the probability. People have never really been taught what really works. And it's not another ticker symbol, right? It's not another ticker symbol. It's not another newsletter. That's the insanity part. People think, oh, no, now it's a bond fund. Now it's an ETF. Now it's Microsoft. No, this time it's Netflix. It's the same thing. You think it's a ticker symbol. It's not. What if you owned the casino? What if you knew the probability of winning? Things change. And that's what's happened. That's what my members, they say. I spend less time on this. I spend more time on growing my business, spending time with my spouse, my kids, my grandkids, my friends. I just get the alert. I connect with you. I ask you questions when I need to. So look, if you're serious about safely accelerating your money, then I'm willing to give you my time and help you. I'm willing to literally give you a key to my tools, to my library, to show you exactly how it works. I used to never give this information away to anyone unless they were going to, have me manage a lot of money for them. And I want to give this. I want to give this to people. And I want to find, and I think I found a fair price to offer this to really help the people, those outlier investors, find what really works. And so you have the button here to go ahead and take action and be on the next monthly gathering where I talk about what the price charts are telling us, and you will get access to the training, and you'll see the model portfolios. That's something I haven't even mentioned. I have model portfolios for you. I show you how much to put in a stock, how long to hold it. I show you what to do. This is absent from almost every sort of service. That's why this is so different. Members will often say, I don't even know what to call this service. Because they're actually implementing. They're getting what they want, right? People often believe that they're just diversified, they'll be safe. But actually, that's killing their future. And if they just know when to be in or out of the market and when to do it and how to do it so they can actually implement it, then they get the life that's more secure, that has more choices. They get back control of their money. So thank you for listening. I want to answer some Q&A, some questions that a lot of people ask me. Like I told you before, I founded my company, Fearless Wealth LLC, in June of 1998, and I've been giving these trainings for a long time. And there's basically 4 main questions that I hear. Now, look, if I don't answer your question, you just go ahead and email me. You can email Patty. She runs operations. That's Patty, Patty at Fearless Wealth. If there's a question that doesn't get answered, you just email her and say, hey, RC didn't answer this. Could you answer it for me? But here's the question. The main question one of the first questions, I believe I answered this, but I'm going to answer it, is, will this approach, will this strategy, will this method work with all accounts, or will it only work with certain accounts? And like I said to you before, it works with all accounts, even heavily restricted variable universal life and annuity accounts. It works with all accounts. I know because I've looked into all of them. And, what about the current situation? The second question I get from people is, well, what about the current situation, RC? Like, yeah, it worked a year ago or 5 years ago or 10 years ago or 20 years ago or 25 years ago or 30 years ago or in the 80s, in the 70s, in the 60s. But what about now? Yeah, with all the manipulation, zero interest rate policies, negative interest rate policies, money printing, currency manipulation, none of that is new. It's on a bigger scale, but the world is on a bigger scale too. Manipulation is not new. And the price of the S&P 500 and the world stock market index, they're getting all this information and they're integrating that into their price. So it works even better with the current situation because there's even more volatility. I have a lot of clients and members that live overseas, that live outside of the U.S., and they say, well, that's great that it can work for people inside the United States, but will it work for me living in Australia or Singapore or Hong Kong or China or Turkey or Switzerland or France or the UK? Yeah. This is about probability. It's like saying I'm going to play blackjack in Monte Carlo. Will it work in Monte Carlo? Yep. What about Dubai? Yep, work in Dubai too. It's probability. What about Macau? If you don't know Macau, that's a little old Portuguese colony that China took back in 1999. Yep, it'll work in Macau. Macau's the Las Vegas of China. Well, it will work in Las Vegas. Yep, probability still works. So it works everywhere. And sometimes when I get deep into Q&A with people, they ask, well, what are the tax implications? The reason why you buy and hold is so you never sell, because if you sell, then you got to pay tax implications. I cover that. First of all, even if you did pay taxes and you lived in California, which is the highest taxing state in the United States, 39% Fed, 13% state, this still works. But let's say you don't. I show you how, literally in it's like a brokerage account where you have an amazing amount of choices, but it gives you the protection, the shelter of not paying capital gains until you take your money out of the account. Right? This vehicle has been around for a long time, but it used to only be offered to people who had over $1 million that they could invest. Now today, if you can afford $20 a month, pretty low fee, then you can make sure that all your capital gains are deferred through your entire life into you giving the money to your estate or your benefactors, your kids. Then, there is a way, there are tools that I want to show you. It works. And a lot of times it's just saying, hey, can I do this for me? Yeah, it works for you, RC, but can I do it? Check it out. Check it out. This is what I did. This is my passion. This is not a day job. I want to help people. I want to thank you for being here. I appreciate you being here and having that attention. A lot of questions came in. Again, most of them are getting answered by this. If the ones that are coming in do not, I'll have Patty look at those. She or I will get back to you on those. You can click the money. You can click the button and you can get access right now, so you can be part of the next monthly gathering, get the portfolio, the model portfolio, and start to watch the training videos and really take back control of your life. Thank you so much for being here. I appreciate your time and the great questions and comments that have been coming through. So thanks for that. And thanks, Patty, for making sure that you could see my screen and hear me, and that really helped. Thank you all, and I look forward to connecting and speaking with you soon. All right, take care.